So it's Saturday morning, you're in the right place. There's nowhere else you should be. We're going to cover all the markets, all the market outlooks, all the economists, and we're going to cover all the asset class allocations while we're at it. You heard today morning from Martin Wolf and others about the doom and gloom and the beginning of populism and no solutions. So my question will be to the panelists first about the takeaways from the meeting so far. Have we found any solutions? Is there a big theme that you have now taken away from your research and meetings? Helga.
Yeah, I must say that on the whole, I thought that there is a pretty broad consensus as far as the outlook is concerned. Neither here nor there, nobody extremely gloomy, nobody extremely positive. We would probably be a little bit more cautious on the global outlook than the IMF was, but a little bit more constructive on China, a little bit more cautious on Europe. But on the whole, no major disagreement. And I think not really a particularly intense debate about the macro outlook. The policy discussion might be a little bit more interesting, especially as central banks are signaling that they are nearly out of ammunition and seem to be quite keen to pass the baton over to finance ministers.
Thank you. Joyce, you just had the polling of your investors as well as a big conference going on.
Yes, so we have about more than 1,100 investors from around the world at our conference today. But there are three things that stand out to me as far as some of the key takeaways. The first is just a feeling that monetary policy is not enough to offset deglobalization forces, and that the deglobalization forces are real and are going to stay with us, and that monetary policy can soften the downturn, but it's not necessarily going to return us to either growth or inflation. And alongside that, there is a view that we're not eminently going into recession in 2020, but you have basically a situation where you have a slowdown in the majority of the world. 70% of the central banks easing, and not a clear exit strategy from negative yield. So that was the first takeaway, that monetary policy is not enough to offset deglobalization. I think the second one was that for US-China, there is a path towards which they are looking at selective decoupling, and we don't know what that means for the global economy. So even if there is a mini deal, we're not going to see something more comprehensive or resolution. This extends beyond trade tariffs and includes national security issues. And so the consequences of that for the rest of the world remain to be seen. And in China, there's this old saying that when two elephants fight, it is the grass that suffers. So close to zero growth in Latin America, a sharper slowdown in Europe, but a feeling that we don't know exactly how this will play out for the global economy. And one thing I would just point out to this audience is, in my opinion, there's still a risk that there is an underestimation of the financial market volatility and some of the technical issues that are impacting markets, whether it's related to algorithms, what we had seen in the repo market, some of the technical issues. It is not something that is systemic or about weakness in the banking system, but the way the market structure has changed and shifted and the way the market trades, I think you are still going to be vulnerable to these spikes of volatility that could exacerbate some of the uncertainty that we're feeling.
Thank you. Megan, what will you be writing in your FT column after these meetings?
So to be fair, most of my conversations here have been off the record, so I'm not really sure. But I will say that there have been kind of two main take-homes for me. One is that everyone's really bearish about structural factors. So we're all Japan in the developed world. Central banks are out of ammunition. I don't necessarily agree with that, actually, and we can talk about that later. But that seems to be pervasive in all these meetings. But when it comes to the cyclical factors, every economist had been convinced we were going into recession next year. And that's really abated recently, partly because of this phase one deal with China, partly because of a potential deal with Brexit that, by the way, won't happen. I don't know if you saw the Letwin amendment was just agreed, so Boris he doesn't get to vote on his deal at the moment. So that'll be pushed out further. But anyhow, that's really mollified a lot of investors. So consensus has really shifted, and that's really reflected in my conversations here as well. So structural factors are really bearish, but it looks like actually we might not go into recession in the next year. It might take a bit longer, which is slightly new. The second take home, I'd say, is as an economist, I talk to a lot of other economists, and never has climate change come up so much as as it has at these meetings, actually, in the US at least. I should say abroad, the conversation's pervasive, but here for the first time, economists are really talking about it in a serious way. I don't know if that's because a bunch of foreigners descended on DC, and we'll see if the conversation sticks when they leave, but I think it's great, actually. So climate change has become something that economists are actually grasping with in a serious way.
Thank you. Mikaela.
So I actually called my scenario, Japan is the good scenario, because it does strike me that when I look at the consensus view today, it does look like this idea of Japanification. But it seems to me, especially as a European, that having a long period of actually not that bad productivity growth, very stable political backdrop, and the ability to grow public debt to 230% of GDP without something going horribly wrong, I'm not quite sure that Europe will be able to do that. So I actually think that the idea that Japanification is the negative scenario, I would turn that around. But I think what's interesting is just picking up on the question that was asked to everyone here on the question of, is the market pricing everything in here? And the answer was no in terms of the risks. And I would take away 3 ideas from that. One is, of course, that we could be subject to a number of various downside risks, be those geopolitical ones or just in terms of the economic dynamics. The second one would be that perhaps it means that we're no longer confident that central banks can come in and just scoop up the markets from here and just easily lift up. And I do think we start to see some of that in the markets. There was a time where the market response to not so good economic news would be to rally on it in the anticipation of getting more central bank tightening. Of course, it does vary from data point to data point, but you had a sense that there was this reassurance. I don't think that's the case anymore, and I think that, may be part of what's reflected in the question. And then I think there's this uncertainty from the fiscal policy. I've also taken away from the various meetings I've had a strong consensus that fiscal will be used, although there's probably a lot of disagreement on how, where, and when it should be applied. But if we were to go down the fiscal route, I think that creates a tremendous amount of uncertainty as to what happens next. Fiscal policy, what type of measures, will it be inflationary or not? And then we couple that with a time where the central banks are actually all shifting or many of the major central banks are shifting their mandates. So I would agree with your poll that perhaps not all those risks are priced in an accurate way.
Thank you. And in which countries do you think the fiscal realistically can make an impact?
So I think fiscal can make an impact in many countries. But one thing is what we as economists can construct on paper. So, you do the perfect fiscal policy plan. You make sure that the government is investing in productive infrastructure. Now, keep in mind that infrastructure takes time to roll out, so it typically doesn't give you the big boost. Then you make sure that the government invests in the right education programs. Then it's really good if alongside the fiscal reform, we can have the right structural reforms. And all of this on paper, I can construct a fantastic scenario for you. What are the chances of this actually playing out in the real world, in an electoral cycle? Probably a lot lower. So I think that in terms of sequencing, my view is that ahead of the US presidential election, it's very unlikely that we'll get a significant fiscal stimulus this side of Atlantic. After the presidential election, that may be a different story. And I think there's more potential to see more significant fiscal stimulus on this side of the Atlantic than on my side of the Atlantic in Europe, where it will probably be slower. One thing I will say from the onset, which is important, as this is something Elga and we often talk about, it will not save the rest of Europe just because Germany does a fiscal stimulus plan. So I'm going to take that one off the table from the onset. If Germany were to do fiscal stimulus, we can do the numbers around this. It first and foremost helps Germany. And then it helps the smaller countries around Germany that has a significant export share to Germany. But the idea that that is enough to lift France, Italy, Spain, and really give a strong growth dynamic to Europe, that's just not what the numbers tell us. However, what would help tremendously in Europe is to complete the European architecture. be it the banking union, the capital markets union, and I also mentioned the energy union because I agree with you, Megan, climate is key here. And then also in terms of developing a common safe asset and a fiscal capacity, then we're talking.
Thank you. Elga, you've written and talked extensively about the next downturn and what policy should be pursued.
Yes, so I think on the fiscal policy side, there we need to differentiate also between two things. One is sort of infrastructure spending, educational spending, and so on, that is also very helpful together with structural reforms in order to boost potential output growth. That doesn't necessarily mean a fiscal stimulus in the cyclical sense, which you could argue that with economies near full employment, some of them above that, is maybe less needed now to basically have a late cycle fiscal push. There is some argument for it to just bring inflation back to target, but on the whole, this is clearly about the fact that we have this persistent inflation undershoots has more something to do with the Phillips curve and maybe not so much with fiscal policy. But indeed, one of the key concerns, I think, is what happens in the next downturn. That is something that I guess get asked by clients all the time. What is the master plan? And I think given that central banks are running out of ammunition, the interest rate channel is almost exhausted, in the next downturn, we will likely need some much closer coordination, unprecedented coordination between fiscal and monetary policy to stem a downturn. I agree with, I think, what Joyce and Megan said about the declining risk of a recession near term. And I think there are a number of reasons for it. One is that monetary policy globally is still supportive. Fiscal policy is also not tightening. And we have no major financial excesses or exuberance anywhere. There are a couple of pockets in financial markets that might look a little bit hot, but at the macroeconomic level, there isn't enough financial vulnerability to sort of facilitate a recession. So despite the protectionist push that we see coming out of various sort of populist voter backlash phenomena around the world, I don't think it's enough to create the downturn. So we still have some time to think about how that is going to be countered, and I do think that will require both monetary and fiscal policy working very closely together.
Thank you. I hear when Megan hears that monetary policy is out of ammunition, I can see her moving towards the end of the chair to jump in.
Yeah, so I actually think there is one thing that central banks can do, and I'm rarely an optimist. So the fact that I don't think that central banks are quite out of ammunition probably says something. And I've written about this in a column in the FT, but I actually think that the ECB's TLTROs are potentially incredibly powerful, not a silver bullet. So I'm not saying this is going to solve the fact that we're all turning into Japan, but in the face of a downturn, most central banks end up having to just move their one interest rate, so they can cut it or hike it, and they have to choose whether they're going to benefit borrowers or savers when they move rates. What the ECB has done by introducing these TLTROs, where banks can borrow from the ECB if they lend onto the real economy, is they've introduced a second interest rate, so they've introduced a borrowing rate, essentially. Now, they've set it at the deposit rate, which is the other rate, and they don't have to do that. They could make them different. So the ECB didn't, create this with this in mind, but as it turns out, they have created this. And so what they could do is they could set the borrowing rate really low. So the TLTRO rate could be negative 200 basis points, let's say. And then banks can borrow from the ECB. They get paid 200 basis points. They can lend onto the real economy at negative 50 basis points, let's say. And so you get paid as an end user to borrow. So that creates demand. And there are problems with this, of course, but it does create demand. And at the same time, they could hike the deposit rate so that savers aren't being punished. So they're basically providing a stimulus to both borrowers and savers. Now, that's an unambiguous stimulus across the entire economy. And so it creates a misallocation of capital. Certainly, that's a problem, but hey, so does QE, and in the face of a big downturn, that kind of concern goes to the back burner. So I do think there is this tool, and it will be particularly powerful in Europe, given how reliant everyone is on bank funding in Europe, and it already exists. That's the beauty of it. There are no legal or political challenges. It's already there. But I think everyone else could do this as well.
Megan, can I follow up with one technical question? On the purchases of equities, what is your take for the ECB?
It's never going to happen. Is that direct enough? I don't think that there's any way politically that they're going to make that happen.
Thank you. Joyce, we were talking earlier about the technicals as well as the macro fundamentals. So what is your take on the negative rates as well as very inverted yield curves? How do you read that? Is it recession coming or is it more market technicals?
Well, I think when we talk to investors now, we often will start a conversation and say, half of the sell-off was technical, half of it was fundamental, or the Treasury move in August, 80% of the order book was high-frequency trading. And I think that increasingly you're going to have to answer the questions this way. So when we look at the negative yielding debt, it's about, in our index, about a third of government global bonds have a negative yield, 2/3 of Europe right now. And we estimate that every 10 percentage point increase in the negative yielding debt basically flattens your 530s by about 6 basis points. So all of these things become very interconnected, which is why I think there has to be more of an understanding of some of these market technicals. Similarly, if you increase the Fed balance sheet by 1%, we think that lowers your Treasury yield by 5 to 10 basis points. And we do see purchases restarting in part because of the short-term funding issues that came up with repo. But more broadly, beyond just those specific comments on the market structure, we do just see a big change in the market dynamics because you have the rise of passive investment, the rise of algorithmic trading, and we estimate that in the U.S. equity market, that's as much as 2/3 of the market is either passive or under algorithms. It's not actively managed, and that's made the market more vulnerable to these short-term shocks that we've seen periodically, even as you have a lot of easing coming on in the system. But 16 central banks, eased, in the last quarter, 23. In this quarter, the emerging markets have done less. They could use more of that if they needed to. But I think taking a look at just the world more broadly, I mean, the two countries that have actually had to revise their growth forecasts less are the U.S. and China. And they've also used more fiscal. So I go back to that sort of the fallout from this is actually affecting other parts of the world. And, I would fully agree that in Germany, unless you see an increase in unemployment, I don't see the political will to use the fiscal stimulus at this stage.
Thank you. And just for the panel, what is our view on the negative rates? And do we expect to see negative rates in the US? Who wants to go first? Elga, maybe?
Yeah, so I think the negative rates as such, there's nothing magic, I think, really about the zero. I think for me, negative rates bring two other problems. One is that you get closer and closer to the lower bound, wherever that is. And in some cases, that lower bound could also be zero. But the minute that bond yields sort of get one bounded, you have one-sided risks, and that is potentially one of the reasons why we see more violent sell-offs as well, because bond market expectations are sort of starting to become quite asymmetric. The other problem, I think, with very low or negative yields is that you increasingly see zero coupon bonds being issued, which basically means that government bonds become pure duration products, and at long duration start to display volatility that is very close to large cap equities. So I think that's really an issue. Could it happen in the US? I think as far as bond yields are concerned, I could see a situation where interest rates come down close to zero, as close as they can. And given that we already see a negative term premium of considerable magnitude, I don't see why it's impossible for US Treasury yields to become negative in, the appropriate macroeconomic backdrop, which probably would mean a full-blown recession.
Thank you.
Can I disagree a little bit just in that negative? I think negative rates are different from positive rates in other than just sign. But, if you try to figure out fair value as an investor and you plug negative rates into a Black-Scholes model, you get valuations into infinity. So it does create asset class dislocation, I think, in a way that we probably don't quite appreciate. I think that negative rates have had negative implications for banks as well, but they've been offset in Europe by the TLTROs, which are subsidies, and now by tiering as well, by tiering in Japan. So, I think that a lot of policymakers will say our banks are fine, don't worry about it, but that's because they've done a lot to try to minimize the implications for banks. Nevertheless, I think that they're negative. I don't think we'll get negative policy rates in the States. The Fed has more recently, a few times, batted that idea down, but I do think it's possible that we get negative actual rates.
Yeah, I'd agree with that. There's a possibility of negative actual rates, but I don't think as a policy matter it will go in that direction. Yeah. But are you going towards zero interest rates? And let me just throw out that we asked this question about the U.S., but if we take a 10-year view on this, could you be asking this question about China? So let's just take a look at the China dilemma. You have, a debt burden that's, 250 to 300% of GDP. You have a consolidated fiscal deficit, looking at the local government financing vehicles, that's double-digit. And if you take a look at their credit growth, the total social financing, 70% of it is used to pay and service the debt. So are you going to be under pressure to bring yields down in China and to use that as an instrument? And what does that mean for the world at large, as we sit in a world that already has about a third of global government bonds at that negative yield? It means we're not going to come out of this very quickly. And whether there's deliberate policy or not, you can see the direction in which the pressures are coming.
Okay, you heard here first, search for coupons and negative yields in China. Michele, what is your take on that?
I mean, just maybe picking up on what Elga said, I think that there are indeed concerns coming from the very low rate environment. And I think an additional concern is what we're seeing is that investors are also moving into more illiquid assets. So I think we're seeing a world where it's not just about the hunt for yield, but it's also about being willing to sacrifice liquidity in favor of getting yield, and perhaps also to Elga's point about the volatility, about being less subject to market volatility. Having an asset that can sit on your balance sheet and not be marked to market is actually quite nice. But if we go down that route further, I do think it creates some other concerns. If I look at the European banking system, I would disagree with the idea that the low rate environment is not an issue. It is an issue, but there are several factors. There are several factors that will impact the bank. So one is that a very low flat rate curve is negative. Very low interest rate environment with negative deposit rates at the ECB, which cannot be passed on to retail savers, that is a headwind. At the same time, the low rate environment has so far been creating stronger demand for credit. So that is an off-sector factor because you get a volume effect. And of course, the cost of bank funding also goes down with the lower rates. So you have different factors that work. But as you head into an economic slowdown, we should be conscious of the fact that those factors may start to bite. The more negative headwinds may start to bite. So I would be perhaps a little bit more concerned about what it means in a slowing economic environment, and potentially a more dramatically slowing economic environment, to be in this low rate environment in terms of the dynamics there. I thought it was interesting the point you made, Megan, about the TLTRO. So I did a little bit of math here, and I thought to myself, so if the ECB does, say, TLTROs and gets volume of $1 trillion, and charges and gives a rate of -2%, and doesn't charge on its deposits, that means a 20 billion subsidy from the ECB to the private sector every year. And of course, why not? But politically, that has some dimensions to it. And especially in an ECB where the profit distribution today is quite challenging. So I think it would have some budgetary implications, but of course it's a possibility. And I agree with you, the TLTRO is an interesting tool, but I think we just need to look at some of those cost aspects of it and what the European governments would think about that.
It's less than QE though. At the end of the day, I mean, it's a subsidy, but the potential losses for the ECB, which is what the Germans will look at, are smaller than with just buying bonds outright.
Well, I would disagree with that. Depending on today, those bonds, the financing of those bonds is actually cheaper So today it's still giving positive returns. I don't remember the exact number, but Elga may remember this, but I think last year the Bundesbank transferred almost 3 billion in profits to the German government. So it's still profitable. But if you start off with something that's negative from the onset, it would just have to be subsidized. But it's an interesting idea, and I'm not saying it's not possible, but I think for those amounts there may have to be some political commitment to it.
Maybe just taking it back a little bit, in terms of we have a question from the audience, in terms of the disagreements or divide on the Governing Council about how much easing is needed, how much should we make of it, that debate?
I think actually it's quite interesting that on both sides of the Atlantic we see more disagreement on the decision-making bodies of central banks, and I think that in part reflects the fact that central banks are out of ammunition and as a result are forced into sort of second, if not third or fourth best policies, either because they are out of ammunition and need sort of to find their way around into instruments that have more substantial adverse side effects, especially longer term, or here in the US, where they're essentially dealing with this onslaught of protectionist noise, if not measures, and are effectively looking at something that is a negative supply shock, on which monetary policy cannot do that much. Clearly, you can do something around the negative effects of uncertainty on demand and sort of stabilize that aspect, but effectively, as we saw with the major oil price shocks, central banks are not the right tool to, or monetary policy is not the right tool to address a major negative supply shock. And so as a result, I think we see more division, more intense debates on both sides of the Atlantic. I don't think that this is necessarily unique to Europe. And that maybe is just an indication of monetary policy being overstretched.
Thank you. Joyce, what does it mean in terms of our world and emerging markets? And also, what are the risks from China? We see some slowdown. There seems to be consensus that it's a moderate slowdown. Is there a risk of more than that?
So I thought I would also just pick up on the whole issue of asset valuations and what are investors looking for. So we do a client survey, which often has interesting results on what investors think will be the top performing instrument over the next year. So number one this year was gold. A sense that we are at stretched valuations. Treasuries was in the top three, a sense that yields are actually going to come down for treasuries as well. And emerging markets equities is a perennial. It's always been put out there as a potential top performer. It has almost, this maybe happened one out of the last 20 years. So I just wanted to add that investors are concerned about the valuations right now. We've had the asset reflation. We haven't had the real inflation or the growth. But what does this mean for emerging markets? So we have China coming below 6% growth for the first time next year. For every 1 percentage point decline in China's growth, we think that takes about 0.4 off of global growth. But for parts of emerging markets, particularly Latin America, because of its commodity dependency, we think it's 1 to 1. So you have growth in Latin America this year at close to 0, and it's the 6th consecutive year that it's been below potential growth. So the slowdown in China has implications for emerging markets. The one part of emerging markets that seemed like it was still growing was Central Europe, but you've had a slowdown, in Asia because of the global trade. We're back at global trade volumes now that are at 2010 levels, and if you stay at that level of sensitivity, the implications for global productivity growth are bringing it close to 0. So that's what I think that the conversations with emerging markets are very much focused on, how is this U.S.-China dynamic going to play out? And since many of the issues that are under discussion are more structural in nature, not just about a mini deal, not just about the tariffs, but extend into broader issues related to national security. I think this is one where everybody is really waiting to see what is the fallout from all of this going to be. But emerging markets still do have a much higher carry than other markets. So taking a look at the emerging markets local currency debt, it is about 380 basis points above developed markets. So and you also have China's inclusion in the index. J.P. Morgan had announced in September that it will go into the indexes in February. That is also, gathering more attention. And we've also seen some pickup in the ESG investment vehicles and demand as well. We had launched an ESG EM index last April, where the AUM that's been attracted to it now is about $10 billion, which is actually a faster pace of growth than what we've seen in the regular plain vanilla EM indexes.
So is it accurate to say for emerging markets, the global factors matter, but even more so the technical factors like index inclusion is becoming even more important than in the past?
Yeah, both. I don't know if it's either or, but I think that there's a tendency, a lot of people say the biggest gap to watch is that 280 miles between Wall Street and Washington, D.C. I think you need to look at both. I think you need to look at, the market dynamics as well as, the fundamentals more, instead of saying one is better than the other or more important or one doesn't matter. It increasingly the way the market trades right now, and the move to sort of more automatic stabilizers, automatic pricing in the market with the systematic trading just makes it more important to look at that in a more integrated way.
And what does it mean for the emerging market monetary policies or frameworks, monetary and macroprudential? Is there room for different advice from the fund in terms of either capital flows management with this new market structure and the global factors? Or maybe it's not new even.
Well, I think that there's still, concern just on the overall capital flow picture when you have this type of uncertainty. But I think, emerging market central banks still have more scope to ease if they need to. They have more ammunition than developed country banks right now, and they've been, they have not, and the fiscal. I think just, we can have a broader debate in this panel about it, but just, if you have politicians sort of get into the business of, sort of financing the budget through fiscal, that's also very hard to get out of. I mean, just as you think that negative yields are hard to get out of, that's also something very hard to get out of. So one has to be very careful about just the way that that's constructed.
Yeah, and just to follow up on that, so when I was in Jackson Hole this year, it was the first time I'd seen central bankers really accept what Elga points out, which is that central banks can't really address massive supply side shocks. They just don't have the tools. And the response for central bankers was, okay, well, then we need more fiscal stimulus. And I don't think that's going to happen. It seems like none of us really think that's going to happen. And there are problems with it. But there's no follow-up conversation on like, okay, well, if plan A doesn't work, what's the plan B? And the only plan B I hear is actually that, well, central banks will just step in and act like fiscal authorities, which I think is interesting and dangerous in its own right. So we're separating it all very clearly on this panel, but actually I do think that the conversation, the only conversation I've heard in terms of new ideas and what we can do is actually for central banks just to act more like fiscal authorities.
Just maybe picking up on that idea, as an investor, I think the fiscal policy response will take time to pan out, but I do think we'll get there in the end. So I would actually believe that we are at a policy regime change point. And I think that policy regime, and Elga alluded to this as well, with the idea that central banks are shifting their mandates. So it's interesting to think about. The Fed has told us that they'll be more tolerant of seeing a bit of an inflation overshoot. So if we do get fiscal stimulus, if it does start to work, and we do start to see higher inflation, what we should as investors be prepared for is lower real yields, because it means that the central banks will be much slower in their tightening response. And I think this is something quite important. And the other big thing that I, as an investor, I would really be thinking about is consumer behaviors. Now, it's not something that's that easy to pinpoint. But for example, in Europe, what we've seen is that one of the things that's been impacting the auto industry, now it's hard to quantify, but is consumers thinking about their future car purchases in the context of climate change. Are they delaying purchase decisions because they're waiting for a new technology, waiting for a new electrical car to show up, waiting for the infrastructure to be there? We see in a number of European countries, we see things like beef consumption going down. And we've also seen, I saw one of the big investment houses recently revised down its projection for air travel. And I think the shifts in consumer behaviors, but also the shift in investor behaviors will be very important in driving the whole issue of climate change. And I think this is going to be a theme. But these themes are not themes that are going to appear over the next 3 months. These are longer term themes, but I think as investors we can start thinking about them, a policy regime change and a climate change. You know, climate change is something we've talked about for years, but I really see 2015 as an inflection point where it moved about from something we talk about to something we as economists start to build in even to our short-term views.
Elga, you.
Yeah, so for us, the current environment where we are late cycle and the next recession is still some time off is a really important opportunity, I think, for investors to build resilience into their portfolios, which you can do in traditional ways by being sort of overweight US equities, sort of putting some ballast in terms of government bonds, investing in the quality factor. But one way you can also do this is really focusing on ESG, because that will also, in terms of the companies that you select for an equity portfolio, will actually give you something that is very similar to what traditionally in factor investment was sort of understood as the quality factor. So ESG is, even if you don't care at all about all the good stuff that it also does, it is also a very important way in which you can build resilience into your portfolios.
And
Thank
especially if you believe that addressing climate change will be one of the things that will be done on the fiscal side as well, which seems very likely. And you know, remember, the one thing that Germany has done recently is announce a climate change program. I'd like them to do more, but that's definitely the direction we see things going in.
And there could be a step towards some fiscal easing using this topic
Yeah.
as
Yes.
the. This brings us to a question from the audience that is a little bit specific, but the fiscal space in Europe, you know, sort of Spain and Italy and Germany, sort of what is the role of Germany in the long run growth of Europe? We're not talking about the world. What is for Europe specifically?
So in terms of the fiscal space in Europe, fiscal space is a very loose concept. So you can calculate fiscal space in all sorts of ways, but if you're just taking your nominal growth rate and comparing that to your nominal interest rate, and then you can play around with the numbers. If you can get that relationship to be favorable, then you can run a budget deficit that still stabilizes your debt. And the irony is, the higher your debt is, the larger that budget deficit gets to be. So it's a little bit ironical from that perspective. And if you then throw caution to the wind and decide you can, on top of that, just increase your debt levels, and you take Japan as a reference point, you know, there is no limit, or at least not a foreseeable limit. Now, I want to emphasize, I'm not advocating that approach. I'm just saying that the idea of fiscal space is a very vague notion, and there is no exact science to calculate it. I think, again, you know, I realize I think I say this on every single panel I participate in. The most important thing for Europe today is to complete the architecture. I think it will be done. I think it'll take time, however. And I think this is the challenge for Europe. So to me, it's, you know, will Italy find some fiscal space? Perhaps. But I think what's much more important today is also that Italy engages structural reform. There's a long list of things that needs to be done. And it's not just about Italy. It's about all of the European countries. But I would also say here in the United States, structural reforms are needed. Competitiveness issues, the whole competition in the economy is very important. Education, these are very important issues to be addressed if the inequality trends are to be reversed. And I think the inequality theme, it's not just about individual inequalities here in the US, it's also about larger corporate inequalities. So I think those are really big themes to be looked at.
Thank you. Megan?
In terms of fiscal space, just by way of anecdote, I attended a meeting of really senior CDU and SPD members of parliament, and I gave this impassioned speech about how Germany should actually borrow with rates so low, They weren't negative then, but they were really low. They should borrow and they should invest in infrastructure domestically. It would be great for the German economy. It wouldn't hurt the rest of the region. And they looked at me like I had 40 heads. I swear I heard someone whisper who invited her. And at the end, this very senior CDU guy just laughed at me and said, "Oh, Megan, why would we do this?" And I said, "Well, you get more growth." And he said, "Oh, that's such an Anglo-Saxon obsession. Who needs growth? We have really low unemployment. We have a really high standard of living. We're pretty good." And I think the Japanese feel the same way. So, whether they have fiscal space is one question. Whether they have any desire to do anything with it is another. And in terms of Germany being the growth engine of Europe, while Germany was demanding everybody else implement structural reforms in the region for years, Germany hasn't really implemented a structural reform in decades. I do think Merkel has been a fantastic failure in terms of domestic policy on that front. And so Germany actually now has a lot of work it needs to do to liberalize its product and labor markets. And some of my colleagues at the Harvard Kennedy School put out the Atlas of Economic Complexity, and it basically measures countries based on what they produce on two levels. One is connectedness, so if you produce something, how easy is it to jump from producing that to producing something else. Germany ranks really low on that front. And on complexity, which is, how easy is it for you to move up the value chain and boost productivity growth? And Germany is actually really high on that front, which suggests there's not actually a whole lot of room for Germany short of developing new things, which is what they'll have to do. And of course, that's a lot harder. So I'm not sure we should all count on Germany being the growth engine of Europe going forward.
Joyce, maybe jumping to the rest of the world, and also a follow-up question in terms of fiscal space in other countries and structural reforms in emerging markets.
I think structural reforms in emerging markets remain something that is very slow going, and political will is at the heart of all of this, whether it's a developed country or in emerging markets. But very much as Megan said, I don't see the political will to use fiscal stimulus, and I think you would have to see a lot more pain, unemployment really become a problem for that to occur. And so where you've seen the willingness to use more fiscal has been the U.S. and China. It has not really been in other parts of the world. And I think that in the emerging markets, the trade issues really are front and center for many of the emerging markets regions. Particularly for Asia, which is 40% of global trade. Latin America, it's a more of a commodity story. But I think that is something where they really are looking at how are you going to remove some of the business uncertainty around that and really get investment flows going. And this is a difference I think that we do see at the annual meetings this year. At the annual meetings, last year we were really looking at this as geopolitical is the tail risk. And now the geopolitical has become much more sort of embedded into the base case. And you can see that markets are becoming more conditioned to sort of accept some form of protectionism. So is there a mini deal that the market responds to? Instead of thinking that there is something comprehensive. But it's that overhang on trade that I actually think does make a real difference for emerging markets. I mean, trade in many ways has been the lifeline of this. So, there's a focus on, USMCA. Is that going to, get derailed just because there are so many other developments that, have come up, in the U.S. Congress to monitor domestic and international. The questions are very much focused on U.S.-China, USMCA, many of the trade-related issues. And I think that the structural reforms are ones that are just slow-going in emerging markets. They're under discussion. I mean, I feel like I've been watching the prospects for pension reform in Brazil for several decades now. And so it's hard to generalize across the entire emerging market spectrum, but trade is a common denominator.
And your outlook for trade for the next year, is it better or worse than this horrible year?
Well, I think what we see is we don't see a recession because, recessions happen when you have a fall in per capita income. And with the unemployment being so low, with the labor market being strong, you don't have a recession. But we do see a slowdown in growth, and we see a slowdown in U.S. growth, and we see a slowdown in China's growth. So both of those hurt emerging markets quite a bit. So it's not a recession, but it's a slowdown. It's a sense that monetary policy isn't going to stop the deglobalization forces or necessarily bring back growth or inflation. So I think that it is that this is why people are in wait and a lot of businesses are in wait and see mode, in addition to looking at what happens with the trade discussions. And I think a lot of the interesting work that's been done on why is inflation so low has been that the globalization does matter. It's uneven, but globalization matters. So what's happening in global value chains? Some of the exchange rate moves, for example, related to Brexit, on why you didn't have a liftoff in inflation. So I think there's a rethink also on why is inflation so low. It's not just these domestic factors, that the global factors really can matter more, particularly for headline inflation.
As well in emerging markets, not only DM, right?
Yes.
Elga, you wanted to jump in, sorry.
Yeah. So I think Joyce touched on a very important point there with what's going on with inflation, because as we were talking about fiscal policy, I couldn't help remembering how worried we all were, and investors, markets were, when initially the Trump administration announced a major fiscal easing at that late stage of the cycle. Remember, everybody was going on, oh, they're shortening the runway. The only reason why everybody today thinks that fiscal policy is a fantastic idea is because inflation didn't raise its ugly head. And I think, that brings us back to that debate, sort of why is inflation so low? Because I guarantee you that the market assessment of fiscal policy stimulus will change 180 degrees back the minute that you get inflation pressures on the back of that.
Thank you. And maybe in the remaining few seconds, actually, sort of the key takeaways or key asset allocation for our audience. Elga, maybe starting from you.
Yeah, so as I said, for us, really the key theme is that of building resilience. One way how you can do that in a tactical asset allocation is to be overweight US equities and sort of have a allocation of government bonds as ballast against that. So that would be sort of the main theme, the main takeaway for me.
Thank you.
Well, I think there's two themes. I think, much as Elga said, there's this whole theme of will U.S. exceptionalism still hold next year? That the dollar has the highest yield, U.S. growth is higher, and even that the Fed funds rate is the highest yield. So do we still have that the income story is with the U.S.? But I think there's also an emerging market story just because of the yield differential. And that continues to widen. China is going into the index. It's not over-owned at this stage in the game. So I do think that there are emerging markets will get more attention, and I do think the ESG investment will get more attention, because in an environment where there's more volatility, the ESG performance, the one thing it does benefit from is being less volatile, because it gives a higher weight. So it takes out in emerging markets some of the countries, like the Venezuelas, Pakistans, that has actually the China weighting that are not as ESG compliant, but you add in green bonds, but you tend to have lower volatility in the ESG investments, just given the nature of how the portfolio is designed.
Thank you.
Yeah, I'd just say as this consensus on a recession is shifting right now, it's not being priced out in all the markets the same way. So
For the next year, it's like 3 years out. I think a lot of people would ask,
Yes.
if you are asking for 2020, most people are going to say, no, our recession model's at 40%. But if you're asking for 3 years out or 2021,
Right.
you get a very
Correct.
different answer.
Yeah, so sorry, I meant for the next year. But a month ago, I think most people would have still said we're probably going to get a recession next year. So this is shifting right now, and it's not priced the same way through all the markets. So if you look at U.S. banks versus CDS, for example, there is a lot of dislocation and opportunity there.
Thank you. Mikaela.
Well, I think we've heard a lot of very interesting thoughts here. And I think the idea of building resilience is something I have a lot of sympathy for, given my economic outlook. And I think, the idea of thinking about where could fiscal stimulus, which I think will ultimately come, but it will take time, where could fiscal stimulus benefit different asset classes? And I think the theme of climate change is certainly one where I see a fairly consistent consensus across many economies, at least on my side of the Atlantic, to start investing more heavily.
Thank you. And IF is very heavily involved in this initiative. So thank you very much. The panelists, it's a fantastic panel. Learned a lot. Thank you, the audience. Round of applause.